Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage, Eitel.
All right. Hey guys, it's Mark Eitel here, and you are listening to the Mr. Mortgage Show. We are super excited to be with you this week. We've got an awesome show lined up for you. I know I say that all the time. I feel like every show is awesome, but this week we are going to dive into a concept of real estate that was published in CNBC that I think is truly nuts. I think they're crazy for recommending this, and I want to talk you through it. It's called rent vesting. And when I first read the headline, I thought they were talking about reinvesting, and it threw me for a loop. But I quickly figured out what the heck they were talking about, and I want to dissect that for you because I think it could be dangerous for a lot of people. And as always, if you want to participate in this week's show, you can call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. Jen is back there. Are you ready? Okay, she gave me the thumbs up, which is good because sometimes another finger pops up when I ask her a question. She gave me the thumbs up. She is ready. She is womaning the Anytime Hotline. That number is 855-462-7292. You can call or text that number or head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Right in the middle of the page is a big orange button. It says, get your questions on the air. Just click that button, follow the instructions. Your question will pop up over here, and Jen will read it on the air for you. And guys, I will post this article to the Facebook page so you can read it for yourself. And you can find that also on MrMortgageRadio.com. All right, let's dive right in. Rent vesting might be a strategy to get you into the housing market. Wow. I read that and thought, okay, there's going to be some good stuff here. Maybe they're going to talk about the landlord loan. Maybe they're going to talk about some cap rate strategies. I got really excited. And then I realized that what they were promoting is the idea that you stay in the rental property that you currently live in. So you don't own a home. You're leasing an apartment or a house or townhouse, whatever the case may be. They portray an individual who makes a good living but can't afford to buy in the metro that they live in. And that's not uncommon. So they're promoting the idea that they invest in a rental property outside of their area, which right away I don't like that idea because now you need a management company. Now you need some contractors and vendors you have no control over. They're on the other end of a phone call or the other end of an email. If it was me, I'm old-fashioned. I like to drive by my rental properties. I like to be able to knock on the door and see what is going on, but that's just me. I know there are a lot of sophisticated investors who own properties all over the U.S., but I said sophisticated investors. And the idea that a sophisticated investor is still leasing their apartment is probably on the rare side of that occasion. And I know there are people out there that promote this idea. It's not for me. I think if you can afford to buy something, you should buy your primary first. And I'm going to tell you why. If you're going to buy an investment property, you're likely going to have to put 20 to 25% down. Right away, that makes it less advantageous than buying your primary. So if the average purchase price in this country is $400,000, let's just use averages and round numbers, 25% down payment's $100,000. Well, you can buy that property as your primary residence for $12,000, 3% down. If the seller's going to pay your closing costs, you could get into that deal with as little as 3% down. So now $12,000 versus $100,000. Right away, buying the primary makes more sense. And how about this as a strategy? How about buy your primary with a 3% down program? And guys, there's 100% programs out there for primaries if you qualify for the grant. But they're talking about somebody who's earning a decent income. So let's say you make too much money to qualify for the grant, which again is not uncommon. Then use a 3, 3.5, or 5% down program and buy a primary. Live in it for a year or two and go buy another primary. If you've got the $100,000 saved up to put down on a rental, that means you could put $12,000 down on a primary. How many times? I think one of the challenges we have right now in our society is everybody has champagne taste. the very beginning of the pandemic, when rates fell and housing prices hadn't adjusted upward yet, suddenly everybody who was looking at a $300,000 house could afford a $500,000 house. So wait a minute, I can get the extra bedroom. I can get the pool. I mean, a $500,000 house 4 years ago was something else. Now it's a common starter home. But my point is, a lot of people are still burping up that champagne taste, thinking that they're going to go out there and buy that 4-bedroom with a den and a pool. I just have to wait for prices to fall. Guys, I don't think you want the economic tsunami it would take for prices to fall that low, that's an affordable property again. So you might have to get in where you fit in and adjust your desires down to meet your budget. And maybe that first home is a 2-bedroom, 2-bath townhouse. And by the way, guys, that 2-bedroom, 2-bath townhouse is an easier property to rent when you move on. If you use that strategy of buy, live there for a short period of time, a year or two, then move and do it again and rent that first place out, a 2-bedroom, 2-bath townhouse has more of a market in the rental side of things than a 4-bedroom with a den and a pool. Not to mention the extra liability of owning a property with a pool and renting it out. My point is that the starter home is an easier opportunity to rent. So take $100,000 right now and go buy that rent vesting strategy, because you got to put 25% down on the investment property, or put 3% down and do it a few times in a row, and suddenly you have a portfolio. Or you could just stay in that property until you build up enough equity to pull some equity out with an equity line and go buy the investment property then with a landlord loan. And you're doing it without having to spend any of your money. It's the house's money. Just make sure everything cash flows. But buying something because you can't afford to buy where you live, so you're going to go outside of your market and buy an investment property and let somebody else manage it, let somebody else repair it, somebody else is collecting the rent. None of that's free. You're paying an additional layer for services. It's going to be more difficult for it to cash flow. I just don't like that idea. I think that that's a dangerous idea. Now, if you're investing in a REIT or you're investing in a fund that owns a lot of apartments and manages everything, and it's, you're just looking at a net return on investment, then, that's a different strategy. But they're talking about being the landlord. So I read that article and I like the spirit of what they're saying, because underlying all of everything I disagree with is the fact that investing in real estate makes sense. I just think it's a stretch to do it the way that they're implying it can be done with rent vesting. Not for the average person anyway. I think the better move is buy the property, live in it, rent it out, move up, move out, move on, and do it again. And if you moved every 2 years, in 10 years, you'd have 5 properties. 5 or 6 properties, depending on where the calendar starts. So I think it's a great strategy, and it's worked well for a lot of people. And it only costs you 3% out of pocket if you use the most aggressive residential primary resident loan programs that are out there. And that's assuming you don't qualify for a grant, because you might be able to do it with 100%. Although once you move out of a primary residence that you purchased with a grant, you're most likely going to have to pay that grant money back when you move. So keep that in mind. But anyway, guys, rent vesting, let me know what you think. Is it a good thing? Is it a bad thing? Would you do it, or would you buy your primary residence first? I'm going to post the article to the Facebook page so everybody can read it for themselves. And I'd love to know your comments on it. Let me know what you think. You'll be able to check it out. Just go to mrmortgageradio.com and click on the Facebook link. Maybe I'm way off. Maybe I'm old-fashioned and I'm the only one that thinks this way. I look forward to your thoughts. Guys, you hear the music? You know what that means? That is my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show. We're going to dive into your questions and comments. You can get those on the air by calling 855-462-7292. Call or text that number, or head over to mrmortgageradio.com. Sit tight. We'll be right back.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show, and we are so excited that you're with us today. Thanks for spending a bit of your day with us. If you have questions or comments, you want to participate, you can call or text your questions to 855-462-7292. That's 855-462-7292. That is the Anytime hotline. Jen is womanning the hotline, and she will get your questions on the air. Or you can head over to MrMortgageRadio.com. That's MrMortgageRadio.com. There's a big orange button. You can't miss it. It says get your questions on the air. Just click that button, follow the instructions, and your questions will pop up on our end, and Jen will read them on the air for you. And speaking of Jen and your questions, let's get right to it. I know we've got some back there, so go ahead, Jen, when you're ready.
Doc sent us this. I found a nice condo, but my real estate agent tells me I won't be able to get a mortgage because of issues with the management. Can this be true? It will certainly appraise for more than what I'm paying. Isn't that all that should matter?
Hey, Doc, this is a great question, and we're getting this more and more since the change in the condo lending rules. So your realtor could be correct. However, there are some workarounds. So let me back up and just say, since the Champlain Towers collapse down in North Miami Beach area, there have been some teeth put into the underwriting of condos, specifically around the condo questionnaire. And they're looking more closely at budget, reserves, and deferred maintenance, because that tragedy was clearly caused by deferred maintenance. And there are a lot of associations that aren't carrying enough reserves to handle major repairs like a roof or a parking lot reseal or who knows what, but they're required to carry a certain percentage of the budget in a reserve account, and a lot of associations aren't meeting that requirement. So because of that, they're ineligible for what we call conventional financing. The good news that there is financing available. It typically requires a bigger down payment, though. So with the traditional mortgage, you could put as little as 3 to 5% down and be okay with a conventional mortgage. With what's available called a non-QM condo mortgage, they don't require the condo questionnaire, so they're not looking at budget, they're not looking at operating costs, they're not looking at deferred maintenance. They're assuming that with a 25% down payment, that there's enough equity in the deal to protect the lender. So the interest rate is slightly higher, and you need to put down a 20 to 25% down payment. Right now, it's 25%. So while, yes, conventional financing may be limited on the condo because of the way the association has been run, you may have alternatives with a larger down payment. So I don't know how bad you want it. You said it was a deal, and you thought it would appraise for more than you're paying. So if that's the case and it truly is a deal or a steal of a deal, then a bigger down payment might make that happen for you. If you have more questions or you want me to walk you through in greater detail, just give us a call off the air. I'll be happy to help any way that I can. But you'll be looking specifically for a non-QM condo mortgage if indeed the association doesn't meet the condo questionnaire requirements as far as underwriting is concerned. So great question. We're getting a lot of that because some of the rules went into effect just recently, and it's making it more and more of a challenge. So great question. I'm glad we had a chance to get that one out on the air. And if anybody else that needs any additional information regarding that, you know how to reach us. Hey, Jen, throw me another question.
This one doesn't have a name. My landlord just sold my house, and the new landlord wants to evict me on paper in exchange for putting the electric in his name and paying the bill. He says this will make his taxes lower. I know this can't be legal. What do you think he's up to? I have more than a year left on my lease.
Hey, another great question. That's definitely some Slim Shady stuff he's up to. So where my mind goes with the whole utility bill thing, right? So he wants to put the electric in his name and he wants a formal eviction on paper. Now, I would never let anybody evict me on paper or any other way because God forbid he records that document. You're now evicted and you have an eviction on your record. And you don't want to do that to yourself credit-wise if you can avoid it. So I definitely would stay away from this one. But as far as the utility bill thing, he's trying to entice you to do it by saying he'll pay the electric. Putting the electric in his name allows him to complete the homestead application. So he can file homestead if he shows the deed and a utility statement. I'm guessing that's what he's doing because you said that would save him taxes. And that's the only thing that would save him taxes is the homestead exemption and the Save Our Homes Act if you're indeed in Florida. I believe you are in Florida. So my mind goes to him trying to scheme and scam and call it his primary residence. And in order to do that, he needs a utility bill in his name. And that whole eviction on paper thing, I wouldn't trust that as far as I could throw it. That sounds super shady to me. So I hope it works out. You said there's more than a year left in your lease. So I hope this guy isn't up to funny business. But if you need any help along the way or you need to bounce another question off us, feel free to reach us either on or off the air. I'll help any way that I can. So good luck with that. But I think that's what he's up to. Hey, Jen, do you have another question?
Sandra sent this one in. I just want to say thanks. I emailed in last week about my insurance being canceled. Christian helped me find a policy I can afford, still more than I wanted to pay, but much better than the other options. Thank you both.
Hey, you're very, very welcome for that. I'm glad Christian was able to help you. And guys, if anybody out there is struggling with the insurance letter, right, regarding either being dropped or a significant rate increase, feel free to reach out to us. We are not insurance agents. We're not insurance brokers, but the volume of mortgage transactions that we run each month introduce us to a lot of really good insurance agents and brokers. Christian happens to be my go-to guy in Florida. He writes in all of Florida, although he's located down in Broward County, Florida. He's actually helped me with policies for myself and my family. So I'm happy to refer Christian out. And we don't get anything out of it, guys. If there's somebody that I know that can help somebody, I'll put you two in touch. I'm happy to do it. We threw together a little landing page and website called HOA Policy Review. Actually, the easiest way to find it is go to mrmortgageradio.com and you'll see the homeowners insurance policy review link. If you click that link and just provide a little bit of information, I'll put you in touch with somebody. And it's not like a service where your phone's going to blow up. It's just me introducing you to an agent in your area that we've used in the past. We don't get anything out of it other than the satisfaction of helping our listeners and our clients. So I hope that helps. And I know firsthand the frustration of getting that darn insurance letter in the mail. I tell you what, there's nothing more frustrating. Hey guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing mrmortgageradio.com. That's mrmortgageradio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And we thank you for listening. Thank you for participating. We've had some great questions so far. I know we've got some more back there, but guys, we've got time. If you've got questions or comments, just call or text 855-462-7292. That's 462-7292. That is the Anytime Hotline. Jen is womanning the Anytime Hotline, and she'll get your questions on the air. Or you can simply head over to MrMortgageRadio.com. That's MrMortgageRadio.com, right in the middle of the page. It sounded like a computer salesman.com. MrMortgageRadio.com. Right in the middle of the page is a big orange button that says get your questions on the air. Just click that button, follow the instructions. Your questions will pop up on our end, and Jen will do the rest. She'll read them on the air for you. Yeah, so let's keep those questions coming. And speaking of questions, let's indeed keep them coming.
Becky sent this text. We're buying my mother's house, and she's offering it to us for about 75% of what it should appraise for. Since the price is so low, can we borrow 100% of the price?
Hey, this is a great question. And we see this a lot where the parents, they're intending to gift the property to the kids anyway, but now they want to move, so they'll sell the property at a discount. So yes, to answer your question, you can, but it's not as simple as, let's use round numbers, right? You said it's worth 75% of the value. So let's say it's worth $100,000. And I know there's no $100,000 homes out there unless you live in fantasy land and it's not on Unicorn Lake. But let's say, for the argument's sake, to give this example, the property's worth $100,000. You need a $75,000 loan to buy that property. So don't write the contract for $75,000 and expect to borrow 100% of the contract price. Write the contract for $100,000, and your mom can gift you the $25,000 for down payment and for closing costs. So you might end up with a loan of $75,000. You might end up with if you roll your closing costs in, of say $80,000. But it's a gift of equity. She's not giving you cash. It's a gift of equity. So write the contract for $100,000 if it's worth $100,000. And then whatever that number that you negotiate with mom as a gift of equity, and your mortgage company should be able to do the rest for you. It's a wonderful, wonderful strategy. You essentially end up financing 100% of the acquisition of that property, and mom gifts you that equity. And that's assuming that in that example, she doesn't need any of the cash to move out. If she did need some of the cash, she could gift a little bit less, and you could borrow a little bit more. But yes, gift of equity might work in this case. It sounds like it's the perfect fit. If you need help with that strategy, please give us a call off the air. I'll walk you through how it works. We do it all the time. We see it in states where there are a lot of older people, retirees, right? In Florida, a lot of times the parents are ready to move into a smaller, easier to manage property, and they'll sell the big house to the kids with that gift of equity strategy. So I hope that works, and congratulations. It sounds like a wonderful opportunity. And if you need any further details, just touch base with us when we're not on the air, and I'll walk you through it in greater detail. I appreciate that question. Hey, Jen, can you throw me another?
Randy sent this text. We bought our place a little over a year ago with an 8.125 percentage rate. I said if rates hit 6.5, I'd refinance, but now I'm hearing they'll hit 6% next year. Do you think this will happen?
Wow, the great rate debate. Man, I wish I knew. I wish I had a crystal ball. I mean, we've been pretty consistent with not buying into all of the rate cut hike. I think we're at a point now where rate hikes are in our near-term future, whether it's this year or the beginning of next, I'm not sure. Although the Federal Reserve cutting the overnight rate does not directly impact the mortgage rate, that's a whole nother show. Rates aren't far from that 6.5% right now, though, to be honest with you. We're looking at rates this week in the high to mid sixes, so you might be in a position to do it now. If you're going to hold out for 6, that's the danger of this thing, right? I'm going to do something if I can hit 6.5, and then you're at 6.5 and you think, man, we're going in the right direction. Finally, can we hit 6? And then 6 turns to 7 and you lost your opportunity. So I think long-term, the trajectory of rates is down. How fast that happens and what circumstance you're in currently to want to trigger this refi, other than to get away from that nasty 8 1/8, 6.5 is definitely doable right now. You might get in close to 6. depending on the loan program. And if you buy the rate down a little bit, it wouldn't cost a lot to buy the rate down. And you can use your equity to buy the rate down. So I don't know. I'd love to talk to you more about it. I don't have a clear answer. If you asked me last year, I'd say no, there's no way. And we did say that last year, that there's no way we're going to see a rate cut in the next 12 months, and we haven't. Where we are now, though, we're starting to see the economic data is a little more favorable. Although the PPI and CPI contradicted one another this past week, at least it's not two bad reports. It was one good and one bad, and the bad wasn't that bad. So if you can afford it, holding out for 6 might be a good option for you. If you want 6 right now, you might have to buy it down from, say, 6.5. But I'm happy to talk through the actual cost of it and the break-even point and see if it makes sense for you. A lot of people get super excited about a refi just to lower that rate. They're upset with the rate. They want it behind them, but they never really look at the cost of the refi and how long it's going to take to break even. I mean, if you're only going to live in the house another couple years, it might not even make sense to do it. That's what you got to think about. What is my break-even point? Take all of the closing costs that you've got with the refi, including discount points if you're buying the rate down, and divide it by the monthly savings. How many months it costs to break even from the expense of the refi, and then you're making money after that. So I hope that helps. It's a tough one, right? Because we're right on that cuff. You're probably close to 6.5 now, and rates have pulled back a little bit over the last couple weeks, so people are starting to feel pretty good about the future rate environment. I wish I had a more clear answer, but don't get emotional about it. Pick a strike point and strike when you hit that. Don't keep moving the goalpost, because you might see rates go back to 7. If we get a couple more inflation reports that show inflation is still sticky and going up, and we've seen that over the last 6 months. We've had a few good reports and a few bad reports, and that's why everybody's so uncertain with what's going on. It might push rates back closer to 7, and then you're playing the waiting game again, though. But, hey, call me off the air if you want to talk about it in detail. I love geeking out on the rates. We can talk about mortgage-backed securities and go the whole 9 yards if you want to go that deep. But great question. Let me know if there's any way we can help. Okay, Jen, do you have another one ready?
Cassie wants to know, is there a special refinance loan for first-time buyers with an FHA mortgage? I think I remember you talking about this one before.
Hey, Cassie, that's a great question. And this is another place to start being prepared, as it's likely, as we just mentioned, in the next, 6 to 12 months that we see lower rates, preparing yourself for it. And I think what you're talking about is the streamline refi. It's just a simple rate reduction. It's super, super easy. There's very little paperwork. There's no appraisal required. There's very little documentation. As long as the mortgage has been paid on time, you're almost guaranteed a streamlined refi. There's very little that can go wrong. So I don't want to say nothing can go wrong, because it can, but it's a very simple process. It's called an FHA streamlined refi, and the goal is just to reduce the rate. You can't take cash out with this program, but you can turn, to use that previous example, you can turn an 8 1/8 into 6 1/4, 6%, 6.5%, wherever rates are of the day, with a pretty easy transaction. So, and that goes whether you're a first-time home owner or not. A lot of people assume FHA is only for first-time buyers. It's not. You can use an FHA loan one after another. There are some restrictions, though. If you're going to keep the property and rent it out, there's a distance requirement that you have to move before you can get another FHA loan. But if you're selling your primary and buying another primary, then yes, the FHA loan can be used back to back to back to back. So great question. I hope that helps. But I think we're talking FHA refi, and if we are, it is a super, super simple way to lower your rate. And I'm happy to give you more info. If you need it, just reach out to us. Hey guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. If you've got questions or comments, there's still time to get them in. Just call or text 855-462-7292. That's 855 462-7292. That is the Anytime hotline. Jen is womanning the hotline. She'll get your questions on the air. Or head over to MrMortgageRadio.com. That's MrMortgageRadio.com. And right in the middle of the page, it's a big orange button that says get your questions on the air. Just click that button, follow the instructions, and your questions will pop up on our end. And Jen will take it from there. All right, guys, we're going to throw it over to Jen for another question. Let's keep them coming.
This one is from Karen. How quickly from start to finish does a normal mortgage take? We found a house and the seller says if we can close in 2 weeks, they'll take our offer. Is there any way this can happen?
Well, congratulations on finding a house. And yes, 2 weeks can happen, but man, oh man, you got to be ready. It really comes down to how quickly you can react and provide all the documentation. So we drive the bus, but it's you that control the accelerator. So if you've got all your paperwork together, if you can get it all together in one submission, that's awesome. 2 weeks is doable. Make sure the appraisal gets ordered immediately. You don't want any holdups with the appraisal because sometimes during the review process, there's additional information that's needed from the appraiser, and that can add a few days here and there. So get your desktop underwriting done now so you have your approval. That can easily be done. Get all your documentations in and get that appraisal ordered. If all that can happen in the first day or two, then you should be in good shape to close in 2 weeks. I mean, we're doing it. It's all hands on deck, and you got to make sure everybody's on the same page, but it's certainly doable. If you need more info or you want to talk through the details of a 2-week timeline and what to expect, I'm happy to have that conversation with you. But again, congrats on finding a house. It's doable, but you got to be ready with that paperwork. So I hope that helps. And I'm excited for you. Let us know how it works out. If you don't call us on the mortgage side, that's fine. But let us know how it works out. I'm excited that you found a place. Hey, Jen, do you have another question?
Lester is asking, I'd like to take a reverse mortgage and pay it off so I can use it as a credit line if I need it in the future. Is this even possible? Does it make sense? Thank you for taking my question. That was 2 questions, Lester.
Yes, it was. I do think it makes sense, but you don't have to take it and pay it off. You can just set it up as a credit line against the equity from the beginning. You just get approved with an available balance and you can draw against it as needed. Now, you're going to pay interest on that available balance. However, if it's sitting there in the form of available funds, you're also earning interest on it. So there's a bit of an offset there. But I know several people who do it. It's a great strategy to have some emergency funds available that's not going to cost you a monthly payment if you do use them. I guess it's a bit of an insurance policy against hard times. I never really thought about it like that, but as I'm answering your question, that popped into my mind. So I've got a friend, Andy, who uses his exactly like that. It's just there if he needs it, and it makes him feel better. And it's a good feeling to have those funds available. And the cool thing is, once it's closed and done, they can't take that money back away from you. Unlike an equity line, if you get approved for an equity line and you don't use it and property values go down, or something changes economically, they can reduce the equity line, close the equity line. With the reverse mortgage, those are your funds sitting in an account available to you should you choose to use them. They can't touch that money after the mortgage is closed. So a lot of people like it for that reason. Not a crazy question. Not a bad idea. It's a good idea for the right person. Guys, there's so much flexibility with the reverse mortgages. You can buy a new house with a reverse mortgage. You can use the strategy as we're talking about, just as a rainy day fund, if you will. So great question. I appreciate that one. Hey, Jen, do you have another? All right, let's go.
Carlos sent this. Since it's now cheaper to rent in many cities, do you think prices will start coming down? I'm wondering if we should wait 1 more year.
Waiting is the hardest part. Man, oh man, Carlos, I don't have a good answer for you, my man. I know people who've been waiting for 3 years and property values just keep going up. In theory, what you're saying makes sense in some instances. If suddenly it was far cheaper to rent than, if somebody wanted to sell and the competition was rent, then maybe I could see that happening. But we talked about it before. Historically, 2/3 of the population own real estate, meaning a third either never can qualify or just isn't interested in participating for whatever reason. And that statistic's been pretty spot on for about the last 50 years or so. And that's where we are right now. So I don't know that every renter wants to be an owner. So even if it was cheaper to rent, I don't know that that pushes property values down because there's so many other benefits to owning rather than just the cost. Great question, great insight. I just don't know that the two correlate as directly as you're thinking they do. If you truly want to buy and you're truly ready to buy, I don't know that there's really a bad time, assuming you can afford it. And what I mean by that, I've got clients, I've been doing this for a long time, guys. I got involved in real estate lending in 1999. Before that, I was part of my family's company. We built custom homes, or they built custom homes. I did what they told me to do. I was just a snot-nosed kid. But nonetheless, I've been involved in real estate lending since 99. So I've been involved in a couple of housing crashes, if you will. The first one I wasn't really paying attention to, but I bought my first home in the aftermath of the savings and loan crisis, but was deep involved in real estate during the housing bubble burst of 2008, you want to call it? Depends on where you were in the country. It was 8, 9, 10. But nonetheless, I know people who bought properties in 2005 and 2006. Now, 2005 in my area, in my hometown at the time, was the pinnacle, the peak. And I'm thinking of a couple right now who bought a townhouse for $384,000. They were the highest comp in that neighborhood for at least a decade, and it was worth half of what they paid for it at one time during the crash. And they were as upset as everybody else. But they stayed and they paid. They didn't play the game with a strategic default. They didn't go through mortgage modification. They liked where they lived. They could afford it. They continued to pay the bill. Well, guys, that place right now is worth over $600,000 and it's paid off. So yes, they could have made more equity had they bought at a different time, but they didn't lose any money. There was a time where on paper it was worth less than they paid, but it still provided them the utility of a home. They still had their family holidays there. They still, that was home for them. It remains home for them today, and they've got over $600,000 in equity. So yes, they could have had more, but also they could have had less if they had bought at a later time. So if somebody said a long time ago, and it rings true every now and again, that if you're going to make money in real estate, you don't wait to buy, you buy and then you wait. So I think part of the challenge is that we're so hyper-focused on things like price and interest rate that we're treating everything like an investment, and we're forgetting that this is also your home. And if you can stay there and afford to pay, you can wait out almost any economic downturn if you've got a fixed-rate mortgage and you're able to pay the bill. And that's exactly how these people made out. And they bought it. Then they'll tell you the story themselves. They're glad they stayed. They're glad they continued to pay the bill. And they didn't go that strategic default rate that a lot of people try to play that game. So if you can afford to buy, I would make the move. But that's just me. We're looking to buy a place now. We're going to keep the one we have, and we're looking to buy another place. So you're not alone in wishing it was cheaper. But also, too, I wouldn't let doubt hold me back. If you can afford to do it, I would do it. But anyway, that's just me. I'm always optimistic on real estate. Hey, Jen, can we squeeze in another question?
Jesse has this question. Can you refinance an upside-down mortgage? I mean, what happens if rates and prices crash? Everyone is saying buy now and refi, but there's no guarantee.
Jesse, you are spot on. There is no guarantee. If prices and rates go down, it's unlikely that would happen, though, because rates could support prices at some point in that equation. But you're right, there's no guarantees, and you cannot refinance an upside-down mortgage. That's why you better like where you live, because there are no guarantees, and you may be forced to stay and pay. So great question. I appreciate that one. I hope that helps. Hey guys, you hear the music? You know what that means? We have wrapped up another week right here at the Mr. Mortgage Show. Man, oh man, time flies. You give me a microphone and a couple people to talk to, and wow, time goes by quickly. Hey, I hope you had as much fun as I did. Jen and I will be back next week right here, same time, same station. If you need us in the meantime, check out MrMortgageRadio.com. That's MrMortgageRadio.com. All right, guys, see you next week.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Mark Eitel, NMLS 1929005.